While headline UK jobs data looks encouraging as unemployment fell, delving deeper into the details, the picture is less rosy. Headline unemployment fell to 4.9%. That's down from 5.2%. However, this doesn't appear to be due to a significant shift into employment. Employment over the quarter was actually little changed. Instead, the fall in unemployment is largely due to rising economic inactivity. And that, in other words, this is people that are neither in work nor actively seeking employment. As a result, the drop in unemployment is not necessarily the positive signal that it initially appears to be. And this is further supported by a decline in PAYE company payrolls, at least a part of which is attributed to last year's employers' national insurance tax hike and an increase in the minimum wage, both of which are actually having a larger impact on employment rather than inflation. Furthermore, it's also worth keeping in mind that with the energy shock and higher oil prices, this is likely to put further upward pressure on unemployment in the coming months. In fact, unemployment could rise as high as 5.8% heading towards the end of the year. Now, it's also worth noting that vacancies have dropped to a 5-year low. The Office for National Statistics said that the number of vacancies fell by an estimate of 29,000 in the 3 months to March. Now, together, this is not a backdrop conducive to strong wage growth. In fact, the private sector pay growth is around 3.2%, which is consistent with the 2% inflation target from the Bank of England. However, with headline inflation expected to continue rising towards 4.3% by Q3, real wages are set to fall, and this could pressure economic growth. The data also comes ahead of tomorrow's inflation figures, which are expected to show that CPI rose to 3.3% year on year in March. That's up from 3% in February as the energy shock from the Iran conflict begins to feed through to the data. Now, this is all ahead of the Bank of England's rate decision later this month, where the central bank is likely to keep interest rates unchanged despite inflation sitting above that 2% target. Governor Andrew Bailey has attempted to rein in hawkish market expectations, with recent comments suggesting that the market was getting ahead of itself with aggressive BOE rate hike pricing. The reaction in the market, we're seeing GBP USD is falling lower today, dipping below that 135 level. For more videos like this, please do like and subscribe.